You can use the chat window to communicate. Am I audible? Yeah. Thank you, Mr. Ramesh Gupta. So, welcome to this webinar on order flow features and trading strategies. Today we have a guest speaker, Mr. Rajendran from Market Calls. On a request, now he has agreed to talk about order flow features and trading strategies. And today he is going to discuss about two important strategies for order flow. And probably so after this session, the end of the session, there's also a question and answer session wherein you can place all your queries there, and hopefully mentor would try to address those queries. And in case if few queries which are not being attended because of the time lag, maybe we'll arrange another webinar so that all your queries can be answered. So of course, Mr. Rajendran doesn't require an introduction. He's a popular guy, a very well known blogger, Market Calls, and when it comes to the knowledge of market profile and order flow, amazingly immense knowledge. I always use this word, when I'm going to Rajendran for market profile or order flow, I would definitely can expect a scuba dive, going into the deep into the ocean, something like that in a comparison. So without any further ado, let me hand over the session to Mr. Rajendran. Over to Mr. Rajendran.
Thank you, Vinod. Am I audible? Just give me a quick confirmation so that we can start with the session. And in today's session, we are going to talk about the order flow features, the basics of order flow, and some of the trading strategies. So probably we'll be talking about 2 to 3 trading strategies, which helps you to monitor on day-to-day basis, right? And yes, thank you for the confirmation. So yes, here we go. Let's kick start here. Before getting into the session, let's have a quick introduction about me. I'm the one who used to write in marketcalls.in. I'm writing since 2007 onwards. And I used to trade since 2005 onwards. I'm also the co-founder of Traders Cafe. It's a local community in Bangalore where traders come and trade along with us. And that is, my core expertise is in market profile, order flow analytics, trading systems, and automation. Just like every other trader, I also experienced the basic technical analysis, Renko, point and figure charts, range bar charts, whatnot. I mean, you name any tool I would have been tested. You name any trading software I would have been tested. Right? Finally, I narrowed down to 2 things. One is Sammy Broker for trading systems and automation, and Ninja Trader, of course, Bell TPO and Bell Order Flow for market profile and order flow analytics. In today's session, we are going to deal mostly with Ninja Trader 8, and the software which I'm going to use is Bell Order Flow software and Bell R Delta add-on. So these are the 2 things I'm going to use in today's session. Just give me a quick confirmation. How many of you heard about order flow, or how many of you how many of you are using order flow at least? Just you can type it in the chatting tool so that I can get an idea about what kind of crowd I'm addressing. Okay, you heard, you are using, not using. Okay, so using order flow, I use. So a lot of people started using order flow. That's quite an interesting stuff, right? So a couple of people still not using, and some people are still there saying that they are very new to order flow and they want to learn more about order flow. So I guess like it's some kind of a mixed experience crowd. So some people use this order flow and some people doesn't use this order flow. But today's session, we are going to address some of the basics of order flow, and yes, some of the new strategies, what you can derive from the order flow, right? So what exactly is order flow is all about? Order flow is a kind of a visualization tool, right? It tells you what the buyers and sellers are doing in the markets and how the interaction between the buyers and sellers are happening at each and every price level. Probably if you look into the candlesticks, from the candlestick, you can come to know that as let's say you are looking into 5-minute candlesticks. You can only fairly assume that this candle is controlled by the buyer, the candle is controlled by the seller. But how do you know? How do you look into the microscope into the, how do you put a microscope into the candlestick and you can how do you know at each and every price level who is controlling those levels? So it's kind of an order flow is kind of a microscope into the candlesticks, which gives a visualization of the market orders, right? It tells how the buying market orders are coming in, how the sellers markets orders, how the selling market orders are coming into the markets. Order flow tool, it's quite new, and mostly as a user we got equipped to softwares coming only from 2012 onwards. There are no major books for order flow because the concept is itself brand new. And so what order flow explains is that how the orders are coming into the markets. So mostly it only talks about market orders. It doesn't talk about limit orders, right? So what you are looking into the order book is mostly the pending limit orders. If you would have been looking into your broker terminal, it shows you the top 5 bid and ask levels, right? So they are nothing but the pending limit orders, but they don't have any control over moving the markets. Who has the control is the one who is punching the market order, right? So they are the one who is having the control. So we generally justify market order as an aggressive order who moves the market, and limit order are called as a passive order or a pending order, which doesn't has any control over moving the markets. Yes. So what we can understand from the order flow is that how these market orders are coming in. So when the market starts, at every given second there will be a flow of order flow coming in into the markets. So buyers will be coming in, selling market orders will be coming in. So the order flow tool itself, it shows the complete visualization of how the buyers and sellers are interacting at each and every price level where big orders are coming in. It explains multiple things, right? So let's look into it one by one. So it also explains whether the market order is getting executed at the ask price or the bid price, right? So on the order book, if you look at the order book table, you'll be having 2 price level. One is the bid price, another one is the ask price. So here comes the bid. Okay, here comes the bid, and here comes the ask. So if you look into your top 5 bid and ask levels, the limit order book, I'm talking about it, you'll be having top 5 levels. Or if you are in a US market, you may get up to 10 top 10 bid and ask levels. It is also called as the depth of the markets, right? So but whereas the market order, we don't have any visualization tool for market orders. At least you can see the depth of the market from the broker terminal, which doesn't makes any meaningful. Using that, you cannot make any meaningful decision. Some beginner does that, so they look into the order book and they say like big buyer is there, big seller is there, but they may not be a big buyer or a big seller. They might be waiting for some price to come to their price. It could be a stop loss or it could be some other price level, but actually they're not moving the markets. The one which you are watching in the top 5 bid and ask ladder, they are not actually moving the markets. It's tough to visualize market order. That is where the order flow comes in. And order flow shows only executed market orders. It shows only executed market orders, right? So let's say if I am executing one lot of market order, one market order, then in the order flow on the buying side, you'll be seeing one lot got traded, but who is on the counterparty is that someone would have been already placed one limit order. So if I am a buyer, if I am punching a market order, if I am a buyer there, then my counterparty is a seller who is mostly placed a limit order at a certain price, right? Maybe he might be at the top price level. Let's say Nifty currently trading at 10,900. He is willing to sell it to me. He is a seller. When I am buying one lot of market, or when I am punching market order, if I look into the order book, he might be on the top. So one limit order gets matched with one market order. So if you look into the order flow blocks, order flow has both buy block and selling block at each and every price level. Let us assume that this is 10,900, and this is the buy side. This is the buy side, and this is the sell side. So always the right hand side is your buy side when it comes to market order. So you'll be seeing that one lot got traded. That means one lot got transacted between me and some other counterparty. That is between, and one lot is a market order punched by me, and one lot is limit order punched by, not punched, but somebody already placed a limit order at the price of 10,900. Right? So that's how it is. So maybe if you look into the order flow, if you haven't looked into order flow, it'll be looking like this. So you can see a block of buyers and sellers, buyers on the left hand side. So a block of buyers and a block of sellers, right? And you'll be seeing a candlestick in the middle. What else you are seeing is a 5-minute candlesticks. Inside the 5-minute candlestick, you can see there is 124 lots traded over here. They are buyers, and probably somewhere around here, some 859 lots, and again 511 lots. So you'll be able to see the quantum of buyers and sellers who are coming and interacting at each and every price level, right? So each and every price level is called as blocks, and or bricks or TPOs. It has different meanings, and it can be controlled by the software. Like let's say every 1 point interval you want to measure the buyers or sellers, or every 5 paise you want to measure the buyers or sellers. You can create blocks accordingly using the software tools, right? So generally for Nifty or Bank Nifty, I prefer using one block in a low volatile markets, or I move to 2 blocks if it is a high volatile markets. So generally right now what we are dealing is mostly with the low volatile market. So I prefer using the block size as 1 point. I'll also tell you how you can set those block size as well. So let's get back here. So there are 2 things you want to know about here: where to trade and when to trade. So technical analysis, most of the technical analysis says like, hey, there is a divergence, so you should be bearish. There is a divergence, there should be a bullishness. Price is trading around Bollinger Band, so it is bullish or bearish, or price is at overbought levels or oversold level. That's what most of the classical technical analysis talks about, where to trade. It also says why. It also explains, maybe it also explains why to trade. Hey, there is a head and shoulder pattern is there, so you have to go short. But order flow is the only one thing it talks about when to trade and what price to trade. So it talks about how long to wait, how long it will be looking for the buyers and sellers pattern to arrive. And when certain buyers and sellers patterns are about to arrive, probably it tells you that if you are going to enter here, your risk is very small. Probably it could be some 3 ticks or 4 ticks. So which helps you to identify a good trade location. A good trade location is something like you try to, it's a trade location where your stops are very, very minimal. I request people not to turn on their webcam because it disturbs the flow of other traders as well. Just give me a second. Okay, somebody turned on webcam. I kindly request people to turn on, whoever turned on the webcam, just switch it off. Otherwise, I have to find, it's going to take us some more time. Yeah, thank you. So what we can observe from order flow, right? So we learned that order flow helps traders to talk. Order flow talks about when to trade and what price to trade. That's what we call as a trade location. And what we can observe from the order flow. From the order flow, we can observe big orders where the momentum buyers or momentum sellers are coming in, right? Other studies talks about momentum trading, right? So they'll be talking about RSI if it is greater than 65. They say like momentum traders will come. But how do you know that whether momentum traders are coming or not? Here you can visualize where the momentum buyers are coming in, where the momentum sellers are coming in. In fact, it complement your trading studies, right? It also talks about how the liquidity flow is happening. Is the liquidity flow is good today, where more interaction is happening between buyers and sellers, or the liquidity is it's very low today, something like on trading holidays. Let's say New Year is about to come or Christmas Eve is about to come, you'll be seeing a low liquidity flow where most of the institutions might be going out for vacations. So if the liquidity flow is very thick, you'll be seeing that they could be controlled by institutions. or if the liquidity flow is medium, probably it's yet another day where buyers and sellers are interacting. There are not a big buyers are present, there are not small traders are, I mean, it's not small activity is happening. It's any other day. Like it could be just another day, not something like an events. If you look into the events, the liquidity flow will be really big, where big buyers step in, and most of the event days, like election results, earning season, or something like Brexit or demonetization or US presidential election results, RB announcements, or let's say Fed announcements. So those days, the liquidity flow will be very big when the news is about to announce, or once the event is announced, the flow will be generally thick and big. So those are the places where you can understand where the institutional flow is actually happening. So it also explains where the momentum exhaustion is happening, where stop hunting is happening, and how the trapped buyers or trapped sellers are getting trapped. In fact, it is one of the trading strategy I'm going to explain today. And stop hunting, how you can visualize it in the order flow. How do you know that stop hunting has been happened in the markets or not, right? So that the order flow explains clearly. And who should use order flow? Probably the people who think like, I don't have an edge. I know that my view is right, but I'm somewhere getting shaken by the execution. My execution is still going wrong, right? So order flow is a decision support tool which complements your technical analysis, and it can also be used as a standalone tools when it comes to trading strategies. You can still build your own trading strategies purely based on order flow, or let's say you're an expert in technical analysis, but still you are failing somewhere. Even though you're seeing a head and shoulder patterns, but still you're not sure about where to keep a stops or where exactly to enter. If you're facing issues with the entry or exits, probably order flow will help you to narrow down your focus on on your trade locations. It can be combined with classical technical analysis tools, can be combined with price action studies. It is something like Elliott Wave or modern tools like market profile. I generally use market profile in complementary with order flow, right? So, I use market profile to understand when to trade, and where to trade, and I use order flow to narrow down to when to trade. So it's market profile and order flow. Again, it's kind of a mixture, but if you're an expertise in price action, you can combine price action with order flow as well. Let's say at supply and demand levels, how your order flow is exactly playing, how the behavior is going on, what kind of behavior is going on at your supply and demand levels, are your key levels, key support or resistance level, how the activity is going on. Is the activity is getting stronger or weaker, or are you able to spot some weakness at your place where exactly you want to see the weakness, right? So it can be order flow shows you what is really happening in the markets, right? And so these are the typical order flow blocks: bid and ask ladder, and commitment of trade and contract reversals. And today I'm going to stick only to the bid and ask ladder. I'm not going to talk about COT or contract reversal because it's going to take more time there. So bid and ask ladder, I'm going to talk about it. And it also has an volume profile. It's an intraday volume profile for the day, which also gives a bifurcation about bid and ask histogram. I'm going to explain what exactly it is. And then a table tracker, which talks about at each and every candle, right? So there'll be a table got generated. It explains how many buyers are there, total number of buyers. It in fact segregates in the entire candle volume into buying volume and selling volume. That's what here it is represented in the form of ask and bid. And delta is nothing but the difference between total buyers minus total sellers, and delta percentage. So always delta is also measured in terms of percentage. It will be vary from 0 to 100%. Higher the delta means, let's say higher positive delta means a bigger participation from the buyers, and negative delta percentage, higher negative delta percentage means bigger seller participation is higher in that particular candle, right? And then comes cumulative delta. Cumulative delta, it talks about how the buyers and sellers behavior throughout the day, right? So over a period of time, how the buyers and sellers interacted. So who is controlling this particular day? Whether this entire day is controlled by buyers, or the entire day is controlled by the sellers. That's what cumulative delta talks about. Whereas delta talks about at each and every candle how the buyers and sellers are controlling, whether this particular candle is controlled by buyer or by a seller. That's what the delta talks about. And volume is as usual what you see in your candlestick volume. And on the candlestick volume, you'll be mostly seeing what? You'll be seeing only one parameter over here. Let's say 1,000 contracts got traded. You'll be seeing only 1,000 contracts. Whereas the order flow bifurcates, out of 1,000 contracts, how many of them are buyers? How many of them are sellers? That's what order flow gives you. It also has one more feature called delta candles. I'm going to explain shortly that. So let me go back to the order flow blocks. So here is the order flow blocks here. So we talked about candles. So the candles will be coming at the center. So center of the order flow blocks, you'll be seeing a candle. And the buying side will be always on the right side. So this is the buying blocks. The buying blocks here. This is buying blocks. And here comes the selling blocks. The seller blocks are here. Sellers will be listed on the downside. So the total number of buyers, if I add all the buyers and if I add all the sellers, then my delta is nothing but total number of buyers. It's summation of buyers minus summation of sellers. Probably you heard about summation during your college studies or in your high school studies. Right? So summation, it's nothing but total number of buyers minus total number of sellers here. So that's a delta. That's a difference between total number of buyers minus total number of sellers. You can see here in this particular candle, the delta is negative minus 119. Right? So all are represented in terms of contracts. It is the entire volume is divided by 75. So what you're seeing is the Nifty futures contract volume. So if it says one contract got traded over here, you can see here only one contract got traded at that price. Only one contract got traded at that price. That price level, only one contract got traded over here. That means one market order, somebody places market order at that particular price, and the counterparty is a limit order. So that's why it shows that one market order it got executed. Who is executed? Who made the transaction is the buyer made the transaction. Who made the transaction there? Only the buyer made the transaction. Like similarly, you can see this particular price, 808 lots got traded. 808 lots got traded. 808 lots. Right? So 808 lots got traded. This is again initiated by the buyers. It's not initiated by the sellers, but it is initiated by the buyers. Again, you can see 64 here. That means 64 contracts has been initiated by the sellers, right? And so that's what bid and ask ladder is all about. It is also called as a bid ask ladder or order flow or tape reading. It has multiple names. And again, on the left hand side, on the extreme left hand side, what you'll be seeing here is the volume profile for that day. At each and every price level, how many volume got traded? Let's say if you sum up all these volumes at that particular price, let's say this particular price, let's say that price is only 10,895. At 10,895, only at that price, how many volume got generated? How many volume got generated? So 2,000, probably you can select 2,199 contracts got traded, and out of them, probably 60% of them are buyers and remaining people are sellers. That's what you can come to know about it. And you can also see where the maximum activity is happening. You can see where the maximum activity happened somewhere around 10,880 levels, where more trading activity happened. That is why more buyers and sellers interacted. And that total quantity is almost 4,509 lots, right? So that is what you can you'll be able to gauge from that. So it gives you a bifurcation also, whether they are a buyer or a seller, how many of them are a buyer, how many of them are seller. It gives you a brief idea about volume profile. Of course, volume profile itself is a separate study. And what you can monitor from that is that where the high volume activity is happening, where the less volume activity is happening, that you can able to gauge from that. And there are places you'll be seeing quantities like zeros. You can see a couple of zeros over here, and a couple of zeros over here, and a couple of zeros over here. There are many places you might see such zeros. So those are the places where there are no buyers available or there are no sellers available at that price. Maybe price would have been jumped that particular price, right? So that 1 point interval, price would have been completely jumped. There are no trades. There are no liquidity available at that price. Means nobody is willing to supply selling quantity at that particular price if it is on the buying side. If you are seeing a zero at the buying side, there are no sellers available to supply the limit orders. I mean, liquidity is lagging on the sell side. If you are seeing zero on the sell side, that means the limit order, people are not willing to supply limit buy order at that price level. At that price level, there are no limit orders available at that time, right? So that's what it means. And below is a table. Here you can see a table over here which talks about multiple things. There are a lot of software controls are available to tell, multiple controls are available. One is total bid, total buyers, total sellers. Maybe I can show you from the order flow charts. So whatever I'm using is the NT8 version. So NinjaTrader 8 version. And of course, NinjaTrader 8 is kind of a free tool. So this is what you're watching is Nifty contracts charts, right? So I'm going to show you what happened in the last couple of minutes. Last couple of minutes, there was a strong recovery came, and you can see a couple of places where at that one single place, 1,500 lots got traded on the buying side. So big buyer came in at 1,500. That you will be able to gauge it. When and also you can see like 955 buy orders. If you take Nifty charts, right? So if you trade Nifty, probably you'll come to know that the volume, most of the time, the volume, general volume, which will be around 2,000 or 3,000 lots, that's the general volume. Whereas the low volumes will be considering anything less than 1,500 lots in any given candle. It's a low volume. Typically, you can see that the volume flow is really good in the last half an hour. So here, 6,929 contracts got traded. It's nothing but the volume. Total volume for that particular 5-minute candle. Here you can see 2,300 lots got traded, 3,801 lots got traded, 3,662 lots got traded, 2,108 lots got traded. That means the liquidity is very good in the late afternoon. Mostly the liquidity will be really good at the start of the session, and then the end of the session, the liquidity will be good. During middle of the day, at times market will not be interesting. Market will be moving in a consolidation fashion. So you'll be finding less liquidity during middle of the day, right? That's the typical behavior. Every day market starts with good volume. First 10-15 minutes, big volume will be coming in. And then lately, if you start seeing that, the volume will start drying out. And then again, volume kicks in some other places here and there, the volume will be kicking out. And every day, as the market closes, the volume will be relatively good and decent. So mostly because institutions comes mostly at the last half an hour. That's what they call it, as a smart money comes always in the last half an hour, and smart dumb money always comes and participate in the first 1 hour, right? So that's quite true, but no, that's not true all the time. That is true most of the time, but that is not true all the time. That you have to keep it in your memory, right? And I'm gonna show you right from the start how the activity happened. Okay, let's talk about 9 o'clock in the morning. So 9 o'clock in the morning, you can see that a big buyer at the first 5-minute candle itself, big buyer came in, and initially the lots got traded, 8,482 lots got traded, which is good volumes. You can see as the time is going by, the volume started decreasing, and it's decreasing and it's decreasing. First 15 minutes or first half an hour, generally we get a good flow and good volatility also. And later on, the market settles down and the transaction will be very less. That means at the open, the liquidity supply will be very high at the open, and at the end also liquidity supply will be very high. But middle of the day, here very rarely here and there you will get some big contracts, right? And so there are a couple of controls over here I want to show you. So one of the control is, if I go to the table here, you can see ask and bid. So what does it says is that, so the total volume in the first candle, let me go to, here is the total volume. The total volume is 8,482 contracts. And out of that, the buyers, there are 8,041 buyers in that candle, and 8,000 sellers also in the candle. So it's equally, the buyers and sellers are equally present over there. Maybe I'll better choose a different color. Yeah. So buyers here. The second one is a seller here. Of course, it's a software control, right? So total number of buyers and total number of sellers. It gives you a bifurcation at each and every price level. So if you look into this 3,895 candles, out of that 1,978 are buyers and 1,917 lots are from the selling quantity. So that means if I add everything, I'll be getting, if I add everything on the right hand side, right, I'll be getting 1,978. If I add everything on the left hand side, I'll be getting 1,917. Right? That's what the order flow tracks about. It gives you bifurcation. It also gives you bifurcation at each and every price level, who is coming and competing, what kind of players they are. Are they buyers or are they sellers, where the momentum is getting in. And when you're talking about momentum, first we need to understand what are the supported order flow types. Right? So let's get back quickly into the PPT. So the bell order flow, it usually comes with multiple types of representation of the order flow. It's the same information, but every information comes with a different form of representation here. One is called bid and ask ladder. That comes with a default mode. Whatever you're seeing in the default mode is bid and ask ladder. And typically you might find the bid and ask imbalance. Bid and ask imbalance is what I prefer to use, bid and ask imbalance. And next comes delta. Delta is one another representation of order flow. Delta percentage, right, and order flow volume. And so these are the common types, whichever is shaded in blue. The one here, bid ask ladder, and the second one, bid ask imbalance over here. The third one, the delta. So these are quite commonly used delta types among most of the market participants. I prefer using bid and ask delta most of my time. Most of my time, if you're seeing my screen, I'll be using bid ask imbalance. And yes, depends upon what is your requirement. You can use either order flow volume or volume histogram or volume delta shaded volume, right? So these are the other ways of representation. Maybe some other traders might be using it, but I cannot use everything. I generally prefer using bid ask imbalance over here, right? And there are precise strategies which we had on bid and ask imbalance as well. So first, let's look into the bid and ask ladder type. In the bid and ask ladder type, you'll be having, it's the same blocks, but then you'll be seeing you'll be seeing a lot of greens and reds on the buying side. On the buying side, you'll be seeing a lot of greens, and sell side you'll be seeing a lot of reds. Wherever the orders are coming big, you'll be seeing lighter shades. Right? So typically, most of the softwares will be using darker shades, whereas this one, to differentiate, because the NinjaTrader 8 platform is using mostly a kind of a different shaded color. So in order to differentiate, lighter shades is where you see the lighter green is where you'll get a bigger delta. And similarly, a lighter red is where you'll be getting a big quantity sellers, right? So lighter shades are mostly to differentiate big quantity, and darker shades are mostly to differentiate very small quantities. Right? So smaller the quantity, thicker the shade it is. Bigger the quantity, lighter the shade it is. It's exactly opposite, just to match with the NinjaTrader 8 template, because NT8 uses a dark shade in the background. So if it is a big order flow, you might miss at times. That is why the lighter shades are used. And next comes it's the same representation, but we use bid and ask imbalance. It's bid and ask imbalance. You can see not every places are get shaded. Only the places which are shaded is where the momentum is coming in. You can see those are the shades. If you look at the shades, you can see that a lot of momentum sellers are coming in. But how the shade is getting done, so it's pretty easy. We used to compare. Whenever I'm comparing the price, I'll be comparing diagonally like this. I'll be comparing diagonally. So maybe let's say if you look into the order flow block, and typically you have a buy side and sell side. So this is my order flow block of 5-minute candle, and let's say 0 is here, and let's say not a 0 here. Typically, you can find most of the order flow charts, you'll be finding a 0 here and a 0 over here. because price will be mostly traded like this, like diagonally. We compare pricing diagonally because we have bid and ask price. Bid and ask price never will be equal. It will be always, let's say bid is at 100 and ask will be at 99. So always, if the price won't match, the two price level will never match. So you have to compare diagonally. Two prices are never equal. Both the bid and ask price never can be equal at any given time. Right. So let's say the sellers are 10 over here, whereas the buyers are at 100 times, let's say. Buyers are at 100. Then we can say, like, compared to this, when I'm comparing this block, the buyers are 10 times bigger. The buyers are 10 times bigger over here. So I can say, like, the momentum is happening compared to the selling activity. The buying momentum is happening over there. More buyers are coming at that equal price compared to the sellers. It's 10x. Wherever the 10x is happening, just show me. You can instruct the software, and the software will show you the zones where a big buying activity or big selling activity is happening. So you can see a block of selling activity is happening over here before the downtrend is about to initiate for the day. So before the market falls 100 points from there, a block of selling activity, again a block of selling activity happening over here. So that means a lot of momentum sellers are onboarding onto that particular, at that time, a lot of active sellers are pushing the price down. Whereas other places, if you see that, you might be seeing that there are no momentum activities happening. Hardly one momentum activity is happening. Hardly one momentum is happening. So what we need is, and if the market is pushed strongly down by the sellers, you'll be seeing a stack of sellers imbalance on the downside markets, or a stack of buyers imbalance on a uptrending markets. So where the imbalance is happening, it's very crucial, and there are particular strategies which are built on top of this. We call it as a stacked imbalance, right? So it's called as an imbalance chart because it tells where the difference between buyers and sellers is exactly more when comparing diagonally, right? So I'm going to show you on the charts how you can change the modes and where you can see the imbalance, precisely where the imbalance came. So here is the control over here. You can see by default you'll be using bid and ask, and I can switch back to bid and ask imbalance. So when I'm switching back to bid and ask imbalance, you'll be seeing that at the start there are no much of imbalance, not much of imbalance, but lately some sellers stepped in, but not much of imbalance. You can see a sideways market. Mostly you may not find not much of imbalance. At least I would say that imbalance is there if there are 3 or 4 continuous blocks are there, or minimum 4 to 5 blocks are there in that particular candle. But you see mostly markets are trading sideways, nothing much is happening. Market is slowly dripping down, right? So you can see that this day is not highly, some momentum buying happening here and there. They are not strong buyers or strong sellers. But at a key reference level, you can see this kind of activity, like they'll be really pushing the price down, where you'll be seeing 4 activity or 5, 6, 7 more activity you'll be finding over there, right? That is where you'll be able to spot out that the momentum buyers are present or momentum sellers are present in the markets, right? So that says that momentum buying or momentum selling activity is happening. A momentum buying or momentum selling doesn't mean it's not your entry point. Where the momentum is happening, that is what your entry point or exit point. So just because there is a momentum, don't blindly go with that. Where the momentum is happening, that's what you have to look into it, right? So I'm going to give a couple of examples by end of the day, which momentum is good, which momentum is bad. So maybe if you look into that, price was moving up, and at some point of time at key reference level, the sellers again started showing up exactly at the previous day's high. So previous day's high was 10,873, if I'm not wrong. So when that zone, when it's breaking down, it's showing up with a lot of momentum selling activity, right? That it's happened somewhere around 145. That's one of the high alert mode that momentum sellers are stepping in, right? And you can see that price is also closing down. You're finding a lot of zeros over here. A lot of zeros over here means there is lack of sellers liquidity. I mean, only the active sellers are pushing down, but limit order sellers are missing slightly. So that is again talks about the liquidity from the sell side is very, very less. and then they're pushing down again. You can see a lot of stacked sellers coming in, a lot of stacked sellers. You can see it's completely controlled by stacked sellers. Stacked buyers are there, but that's very less in quantity. But who is more is stacked sellers are coming and pushing the price down. And again, even in fact, one more stack selling happened. A lot of, in fact, one big order also got traded over here. Almost somebody came and sold 3,656 orders over there, right? So you will be able to measure what kind of selling is happening, how bigger the flow is at each and every price level. You'll be able to know. But if you look into the candlestick volume, you might be seeing like 13,000 contracts got traded, 6,000 contracts got traded. But where this activity is happening, at what price level is happening? You can see there is a bunch of zeros over here. There's a bunch of zeros over here. Those are the sign that a stop hunting is happening. Typically, a stop hunting is something like there are buyers and sellers up to this level. Up to this level, there are a lot of pending limit orders in the order book, right? So a lot of pending orders are sitting over here. But then there is an empty gap between here. There are in this zone between 10,830 and 10,000, almost 15 points, right? So the entire 15 points. There are no buyers also. There are no sellers also. All in a sudden, the next liquidity is available at these zones. So always the liquidity will be available in zones. Not the buyers and sellers will not be present at each and every price levels in the order book. If you look at the order book, the buyers and sellers are missing over there. That is why when the sellers are pushing the price down, the very next sellers are able to take it over here. They may be able to take it over here. That's what we call that as it's stop hunting happened in the markets. Stop hunting would have been happened because more people would have been kept their stops over here, or more liquidity will be available because more people would have been kept their stops over here. So straight away, when the market is moving down, it crosses the liquidity zone. The next trade would have been happened somewhere over here. Somewhere the next trade, immediately price jumped over here. Right, so that is why you might seen that some of the stop loss order might got skipped. Right, so stop loss limit order would have been skipped. Probably you would have kept somewhere below that, and below that there are no liquidity, so it could jump. It could jump straight away to the next available liquidity zones. So if you're wondering why the stop loss is getting jumped, maybe this is because of the reason you would have placed the stop loss exactly at the lower ceiling of the liquidity level. You would have been kept somewhere over here. So a price comes and try to take it, and next thing is you try to place a limit order. Market would have been sent a limit order over here into the order book, but then the meantime market would have been jumped to the next liquidity level, right? So because of that, order could get jumped, especially if it's a limit SL limit orders. And coming back to the charts, next comes the order flow volume at price, and it talks about volume at each and every price interval. It talks about volume at, so total volume at, instead of showing the bid and ask, it shows the total volume at each and every price interval. It also shows the total volume of that candle. So volume at each and every price level, it shows, and it also shows the total summation of the volume. Again, this is another representation of order flow. If you are not bothered about the buyers and sellers interaction, if you want to know where the maximum participation is coming in, then probably you can look into this volume at price, order flow volume. It's generally under the tab order flow volume. And again, this is again an order flow volume at price. This is another representation where here it is mostly colored with delta. So if it is controlled by the buyers, if the net difference is positive, then it shows that it shows the volume in green color. If the volume is shown in red color, that means that particular price level is controlled by sellers. So then you can see where the more delta is getting negative. So you can see this is the red candle. The candle is red, but you can see, so these are the zones where the more sellers entered in this zone, and more sellers entering in this zone means lately sellers are showing up more. Lately sellers are showing up more, and lately sellers are showing up more. That's what you'll be able to understand from this charts. Right? Again, that's nothing but a different representation of order flow again. Whereas in order flow volume at price, again, wherever you're seeing, it shows only the volume at every price level. Lighter shades area is where the maximum participation happens, and thicker shades is where the less activity, less volume happens. And it's nothing but the total sum of buyers and sellers at each and every price levels. So if you read 1189, right? So that means buyers also included, sellers also included. It doesn't bifurcates. It shows as a one total volume, buyer market order volume and seller market order volume. It shows in a combined figures. And that's what primarily people uses it. And you can identify, we call that as a zero liquidity zones. Zero liquidity zone. That means these are the zones where the stop hunting happens, as I explained before. So these are the zones where stop hunting happens. You know that this is you'll be able to see the behavior of those liquidity zones. Whenever such liquidity happens and market reaches the next liquidity level, market reaches the next liquidity zones, what market will be doing is that market will be doing a lot of adjustments, and generally market has the behavior to mean revert back towards those liquidity zones. Whenever the stop hunting happens, whenever you've seen that a lot of zeros, whenever you're witnessing a lot of zeros, what generally market does is that once it eats up all the liquidity, and then market again goes to the no liquidity zone. So market drops, and then again it goes towards the zero liquidity zones. Zero liquidity zones are most likely to be get filled. It's not support or resistance, but those zero liquidity zones, when you are seeing that the buying side liquidity also not there, selling side liquidity also not there, it does not get filled in that candle, price usually tend to move towards those liquidity zones. That's a behavior you can observe from the order flow time to time. If you're watching order flow, you'll come to know this behavior happens again and again and again and again, right? So it not only helps you to identify where the stop hunting is happening. Once the stop hunting happens, how you can respond to that, rather than stepping into that stop hunting and jumping into that and saying that I want to be a buyer or a seller. Let the price come back to the level, let it comes and clears, then you can take a decision if you still want to sell in the markets, right? So those are the zones. It's not an immediate sell. Maybe if at all, if you still have a selling idea, then probably what you have to do is that once you're seeing this stop hunting activity, probably you have to wait for the price to come back and respond. You have to wait for some responsive buyers to kick in. And once the buyers started showing up and they are coming and filling those the zero liquidity zones, then maybe you can think about shorting or going long. But what you can expect is that whenever the selling happens from the liquidity zone, usually it mean reverts back, right? Again, we're going to talk about a couple of order flow trading strategies. These are very basic trading strategies. On day-to-day basis, you can find this kind of trading strategies occurring somewhere either in Nifty or Bank Nifty or some other stocks, right? So before to that, there is a crash course on order flow coming in. It's a 2-day crash course starting on 24th and 25th of February 2019. And here is the link available there. Maybe I'll post the link to the, or you can still Google order flow crash course market calls. It calls order flow crash course. So here's the link. You can still Google and get it out, but I'm just posting the link in the chat section. It is for the people who want to get expertise in order flow. I'm going to send to everyone. So where we'll be talking about some 8 to 10 strategies is what we'll be talking about in the order flow section. And we'll be covering end to end the entire way how you'll be dealing with order flow charts. So this is one of the trading strategy. It's an R delta. It's an add-on to order flow. It's again, it talks about where the momentum auction reversal is happening over there. And this is a strategy which is built on top of the delta. The delta, if you look into the delta itself has 3 categories. If you look into the delta itself has 3 categories. Right. So if you look into my table, I don't use bid and ask because I'm a more of an, we look into delta, we prefer to give more information to delta, right? So delta this is the total delta. It talks about total number of buyers and sellers. Maybe let's take this big candle example. When the market is falling down, the delta was hugely negative, 3,948 candle, right? That is the delta. If you are watching in a live candle, these values will be keep on varying up and down, up and down, up and down all the time. It will be keep varying all the time, right? So that is what it is represented in the form of delta candles. The delta candle always it starts at 0. When the candle starts, it will be at 0. When the buyers are showing up, it will be moving to positive. And when the sellers are moving, when sellers are taking control, it goes down and it becomes negative. So like a candle, it also moves up and down like a candle, right? So what will be recorded over here is that what is the maximum delta level it reached? What is the max level of delta? What is the max level of delta? What is the max level of delta? And what is the minimum level of delta in that 5-minute charts? What is the minimum? What is the minimum delta in that 5-minute candle? It will be recorded. And finally, the closing delta. So let's say the delta closes over here. The close of the delta. The close of the delta is what the actual delta over here. Whatever you're seeing is that once the candle completes, the delta value gets stabilized and the next candle opens. That's the closing of the delta over here. Likewise, it also records maximum delta and the minimum delta. So those R delta strategies are specific signals which helps you to understand where the momentum exhaustion is happening. It is precisely it's precisely measured based on the delta. So if I compress the charts, you could see that a couple of can see RD long got generated, RD long got generated. Typically, we'll be applying this R delta on a range bar charts. So we'll be using range bar charts to apply this. So probably I'll be using we'll be using range bar charts. Okay, I'll show you a couple of controls. With the range bar charts, looks like this. So whatever you're seeing here is an range bar charts, right? So something like this, it helps you to uncover. You'll be seeing a couple of lines over here. So the center line is the VWAP. We're seeing in VWAP lines. It's a VWAP. And you also see +1 standard deviation VWAP levels and -1 standard deviation VWAP bands, -1 standard deviation VWAP bands. And here I'm using an 200 range bar charts. Typically, I'll be using 200 range bar charts or an 160 range bar charts. And the size, whatever you're using here, is closely 1 TPO size. So typically, we'll be trying to get some 8 blocks of TPO. And whenever you can, it gives you it gives you signals in the form of RD long. It's where the momentum exhaustion, momentum seller exhaustion is happening. Wherever the momentum seller exhaustion is happening, and you have it always gives the signals relative to where the VWAP is getting traded, right? So by default, the software users looks for a minimum of 0.15%, 0.15%. So that's a software setting again. 0.15% settings. If that 0.15% setting is there, then it typically shows if the price is deviating from 0.15% from the VWAP levels and momentum exhaustion is happening, you'll be getting an RD long entry points, and typically you'll be getting an RD short, especially when you are seeing similar structure over there, and if the difference is 0.15. Typically for scalpers, it will be useful, and where the basic expectation is towards the VWAP levels, VWAP levels over here. Again, this is one of the signals which you can get it over here. So a couple of RD longs which got generated in today's section. Over here, so there are a couple of RD longs. Are coming in over here, and one over here, and finally it end up with an RD short over here, right? So and then next comes the trapped big buyer or a trapped big seller concept. One of my favorite concepts. I'm going to take a little bit of example, a little bit of time over here, and I'm going to show you some of today's live example as well. So at the market open, if you see today's market activity at the opening itself, you could see some trapped big buyers and price started going down, right? So whenever you're seeing that, maybe before talking about today's activity, I show you a live video about, I captured one of the day, big buyer, big seller activity. I kept around documents and let's say kept under Zoom and order flow examples, probably here. This is the one. So I think this is the auction which is generated on 3rd of January. This is this month, 3rd of January. So you can see, I'm going to pass the video here before explaining. The market was dropping down. The market was dropping down, in fact. A lot of momentum selling was happening. You can see a lot of momentum selling was happening, and a lot of momentum selling is happening. And when I captured it, right, so probably the other candles got started, but then what I seen is that I'm seeing that big seller was there. That's a big seller. We call that as a trap seller because it's a day low. This is day's low. Whenever the price touches a new day low, and I'm seeing a big seller, followed by that lot of selling quantity, followed by that price started moving up. When the price started moving up, that is a clue that you can use that as a stop loss, and you can say like that is a trapped big seller. So trap big seller, you will mostly get a scalping opportunity. And as the market starts, I'm going to start playing the markets. So these are taken a live video. It's a live recorded video. Usually what the price does is that whenever you're seeing that price, usually price tend to move towards towards the VWAP levels. So that's a big seller. Live markets, I was just recording that. By that time was around 12:32. That's my system time over here by that time. To show that that's a big selling orders. That's a sell order was there. That order got trapped. Usually these kinds of behavior, it used to happen either in Nifty or Bank Nifty. In a week, at least 1 or 2 such kind of orders, it comes in, and that gives an immediate, with a tighter risk, your risk is just only 1 or 2 ticks below that block. So probably you can place an stops around this band. That's where you can keep an stops over here. The moment you're able to spot on big orders, it's a kind of a scalping opportunity. Immediately you have to jump in. I mean, I'm also taking a screenshot and to show that there was a scalping opportunity. Maybe I just, let's not waste time here. I just fast forward. You can see the activity, as the activity was happening up and down. What you can see here is that you can see the buying quantity is getting added. Every time the price reaches a certain level, the buying quantity gets added to its previous level. And you might see one block here. It's called as action bar. So these action bar talks about last 5 trading activities. Only talks about last 5 trading activity. Whereas your current candle is over here. This is your current candle. So this is your current candle. Whereas this talks only about the recent top 5 buyers and sellers activity from the current price. Okay, maybe the watching at a market speed is very slow. I know that. So maybe I'll fast forward a bit. So the activity it's coming at pretty slow rate. You can see a lot of zeros are happening, mostly because of its lack of liquidity. It is mostly because of lack of liquidity. You can see a lot of zeros happening. So here means there are no active buyer limit orders present at that markets. That is why it's generally called as a poor facilitation of a trade. The trade facilitation is not happening properly over there. Maybe lately what happens is that market could come and revisit all those zero zones. Not every zero zones we will say it come and mean revert. Some of the zero zones we'll call it as a support or resistance. That we'll be taking in the order flow course mostly. So that's a fast trade over there. So we have a community where we will be talking about order flow and market profile on day-to-day basis. So I noticed that there is a big seller came at the day's low. That's they get trapped, and that is where I started taking the video to explain that how that's. I also say that it's a temporary scalping bias. It's where you can use it for scalping opportunity, right? So, but you also have to aware that it's just a scalping opportunity, and you have to leave it out because maybe at times price could come and completely clear all those levels. I mean, it's just a temporary buying opportunity. Whatever you're seeing is a temporary buying opportunity towards the VWAP levels. So initially you've seen a lot of zeros, but some of the zeros got filled. Some of the zeros are not, right? So still that is an low liquidity zones. Often market moves from high liquidity zone to low liquidity zone. Again, you're seeing a couple of zeros over here and sellers are filling it up. That's how a good auction will move. A good auction will be filling up most of the levels and it moves. Maybe by that time the VWAP level was almost it's at above 50 point level. That's a 50 point scalping trade, by the way. Okay, now coming back, so it's the same thing. It happened at the today's open when the market opens gap up. Of course, the price opens gap up today, and it almost opened some 60 point or 80 point higher from the previous day's close. When price opens gap up, initially it showed up big buy order, and then price immediately started coming down. You can see that that's a fair idea. If you would have been seen the first 5 minutes itself, you would have a fair conclusion that the big buyer showed up and the price started coming down. So maybe price opens here, and then the big buyer came up, and then once the activity started coming down, you would have been noticed that there is a big buyer got trapped. So you can use this as a stops, and you can enter over here. Even if you haven't entered in the first candle, probably market would have given you clues that second candle. In fact, it also broke on the 2-day high. The 2-day high. If you look into the 2-day high, the 2-day high comes around. Maybe let me go to the charts. Show you. At the open itself, it broken 2-day high. I mean, if you look into the market profile activity, here is the 2-day high. It broken 2-day high. 2-day high. Some big buying activity happened at the top, right? So somewhere here, this is today's activity. This is today's activity. Big buyer showed about 2-day high, but despite that, market started dropping down. That is a sign that it's a temporary momentum exhaustion sign, where you can make use of that as a scalping opportunity, right? So means when you're done with 20-25 points, you should be out of the game, something like that. So it's at the opening itself, it's a scalping opportunity came, and later market started dripping down. Market was dripping down till around 12:45. Till that time, it started dripping down, and that is an opportunity to fade with a very tight risk. You might have that kind of tight risk at the open, because price started looking about 2-day high, and it failed to hold about 2-day high, and lately a lot of sellers started showing up, but the sellers showed late. But you got a very first clue at the opening itself what the market could possibly do when you're seeing and buyers got trapped at the day high. So maybe this is the day's open. Days open, you could see this big buying quantity. A lot of buyers try to do that. There are a lot of buyers try to push it up, but there are not enough buyers to support. All the buying activity got absorbed. We call that as an absorption, and later sellers started showing up lately, and they defended that level. That level got defended, and your stops would have been kept very tighter fashion. That's precisely that is a trading opportunity to fade towards the value VWAP levels. VWAP levels is the primary target. What you can expect here is that you can expect VWAP levels to be get tested. Or probably you can use some 20-25 points as a scalping opportunity with a 2-point risk, which is the risk reward ratio of 1:12.5. Right? And you can also use 3:25, which is still still more than 1:5 risk reward ratio. At a very tight risk, you can operate when you're seeing these kinds of information. Still, markets are trying to be very close to that level, and then it started slowly dripping down. That's one of the trade where you can able to say that that's a trapped buyer or a seller, but still you have to be aware that that price level can be tested for the day. But today price came very close, just 2 points very close to that, but still they're not able to take out for the day. But still tomorrow, maybe if not today, tomorrow that level could be taken out, because that's a bad that's a bad high. We call that as a bad high. Generally, those bad highs get cleared either intraday. If it is not cleared intraday, at times it will be cleared tomorrow. By tomorrow, you should be expecting that level to be get cleared. So that's still a bad way to do an auction. That's why we call it as a trap buyer or a trap seller. That is temporarily bearish, but eventually those levels will get bought. And those are the places whenever you are able to see that trap buyers or sellers, what you need is you need couple of trading activity to happen above that. So if you are on the buying side, right? Let's say, if you're on the sell side, you need some activity to happen, some couple of blocks to be happened above, and then price has to come down. Then only you can witness those trap buyers or sellers, and you can take advantage of them by placing a tighter stops. Whereas the example which I shown over here, maybe I'll go back to the video and the video which I shown over here. So the video which I shown over here, right? So you got a trap seller, and then price started coming up. You can see a lot of selling activity happened. All the selling activity got absorbed, and buyers started showing up. That's a sign that it's a temporary sign to fade the markets towards some decent opportunity. In fact, this move went up till 100 points. This move went up 100 points from here in Bank Nifty, which is quite a significant swing, where you'll be able to identify such swings very earlier with even a tighter stops. The stops was hardly 5 points, at 6 points when you notice it. Maybe if you're very late to the market, you could be able to you'll be able to see that at 10-point difference, you'll be able to see that these kinds of price action movements. So with a 10 points or a 5 to 10 point range, if you're faster, you could be able to narrow down with 5 points. If you are pretty slow, if you want to get even more confirmation, still you'll be able to get a confirmation by 10 points stop in Bank Nifty, which is very, very tight, I would say that. Right? And again, that's one of the trading strategy here. One more trading strategy which occurred over here, it's called as a momentum auction reversal, which I also posted in today's Slack in our own community, where you'll be seeing a lot of big sellers. Momentum selling is happening over there, but the volume also relatively big. I will rate the volume as big if it is reaching 3,000 contracts or 4,000 contracts with a strong, deep, with a very big candle. You see that the candle is relatively big compared to the older candle size. The candle was approximately 25 points range. For 5-minute candle, 25 points is a big range. Whereas the other candle are just 5 points or 10 points, 15 points. But this candle, the range, volatility in that candle is relatively big, and the price is dripping down. And that is a red candle as well. It's a completely red candle. Right? The completely red candle. The delta, what is good is that the delta was hugely negative. A lot of sellers are coming and selling in that particular candle. That's why the delta candle is negative. You can see a huge delta bar over there. That means too much of selling activity is happening. Despite that, the next bar is a green candle, and almost not equivalent amount, but to some extent an equivalent amount of volume has been happened when you relate these two volumes. When you're relating these two volumes, the volumes are significantly equivalent, and the volume the price got stopped. So most of the time you can see a big candle followed by a small candle which will be coming in, but when you compare the volume, it will be very closely equal, and subsequently that candle is controlled by the positive buyers also. If you see, the delta will be positive, whereas the delta will be hugely negative. It's just not negative but hugely negative, but some of those positive candle would have been happened. That is where precisely you can use that as an opportunity to, when the next bar opens, that is your entry point. That is where you can say, like, momentum, we call it as a momentum auction reversal. At times it could be the day's low also. What you can generally expect is, you can generally anticipate price to go back and clear the VWAP levels, right? So again, that it happened around that. Generally price goes and mean reverts towards this VWAP level, the brown color zone. It happens, and it used to happen in 15 minutes. The next 15 minutes price was at the VWAP levels. Kind of a scalpers can use these kinds of models to identify those momentum auction reversal patterns, right? So again, that is one more interesting strategy to talk about it. I prefer playing those momentum auction reversal zones. It's because it's very early to identify, and before somebody getting in, you can make use of those auctions. Once you're done with the VWAP levels, you're out of the game, right? So something like that. And that's again another 20-25 point of scalping opportunity. Scalpers can make use of order flow mostly. Yeah, if you have any questions, I'm ready to answer all your questions. And you can also follow me at Twitter handle. I'm actively talk about markets, or some of them macros. I like to track macros as well, to track market sentiments. And I also talk about softwares, automation, order flow, and market profile, right? Yeah, if you have questions, I can take all your questions now. Are you not using range anymore? We are still using range bar charts. We are using range bar charts only for R delta, but for regular trading, we'll be mostly using 5-minute charts or 3-minute charts. Okay, Viren Patel, I'll think about it. I'll try to add you. I'll try to resend you the Slack invitation. And there is a question from Aditya Midela. This question is, can you explain failed auction in order flow? Maybe we can take it out, those questions, in other sessions. Kindly ask questions only related to what we talked about it right now. The volume alert in the order flow software, is it for a candle or for the entire day? You have to ask Bell TPO team, because I don't use any volume alerts. I'll be mostly looking into it visually. So you have, this question has to be answered by Bell TPO team. I can request you to contact them. So what is the R delta? What is the period you need to maintain? When you are using R delta, you should be using only on the range bar charts, right? So better avoid using on a time-based chart, like a 5-minute or a 3-minute time frame charts. It doesn't make much of the sense. It's good to use R delta on an only on a range bar charts, that too with 8 blocks. You need to keep 8 blocks over there. So means your if your tick size is, let's say, 1.1 block, then you have to, let's say you are using an order flow of 1 block order flow, then you have to set an total 8 blocks of order flow. That means 8 blocks multiplied by your tick size usually gets you the order flow blocks. What is the difference between footprint chart and order flow chart? It's same name, nothing much. Footprint chart is order flow is footprint charts. But then people just trademark in a different name, that's it. Some people call it as a footprint chart, some people call it as an order flow. The general term is order flow. So what will be the tick size of shares below 500? So I have a specific rules over here. Maybe I can put in a notepad so that you can make use of it. So generally the tick size is 0.05. Most of the vendors, the global data feeds are true data. They'll be using a tick size of 0.05. right? So based on the stick size, you have to generalize. You have to come up with a brick size concept. Brick size, or you can also call it as a TPO size, or many software use like an price per row. These are the terms. Price per row. These are the terms which is used by many trading analysis software, but ideally they're pointing to only one thing. If I want to use a 1 point, if I want to want a 1 point block in order flow tool for Nifty futures, let's say for Nifty futures, then I have to use a TPO size as 20. That will be multiplied by 0.05, so that you can get a 1 point block, right? So my setting should be 20. 20 is my setting. I have to key in my trading software. This is for Nifty futures. Whereas if you're, let's say your price range, depends upon your price range. Maybe the 1 point block you may not apply to Ashok Leyland, because the entire day you will be getting in one point range or a 2 point range, something like an S-Bank charts. In a day you will be getting only 5 points or 10 point movements. So those are the days it's better not to use a 1 point block. So to see more in-depth information, you need to use an optimal block size. So which is the right block size? Here is the guidelines here. So if the price range is less than 100, if the price range is less than 100, let's say this is the price range. Price range is less than 100, then you can use a brick size. Use a brick size of 5 paise TPO. So 5 paise TPO means you have to set in the software setting, you have to key in 1. That will be multiplied by 0.05, and you will get 5 paise TPO. So this will in turn will be multiplied by 1 into 0.05. That usually gives you 0.05 paise per block. Each and every block will be 0.05 paise. So every 0.05 paise of trading activity, the buyers and sellers will be plotted over there. Right? So let's say your is somewhere between more than 100 but less than 500. In that case, you can use a brick size of, I prefer using a brick size of 0.25 or 0.2 or a 0.25, whichever you prefer, you can use it. I mean, or 0.1, in fact, 0.1 might work good. So means every 10 paise per block, 10 paise per block. That's what it means. That means in your software, you have to set, 2 is what you have to set. That will be multiplied by 0.05, and it gives you 0.01, the 0.01 block, paise per block. Or if it is less than somewhere between 500 to 2500, so 2000, then you can use 0.2 as the settings, or 2.5 as the settings. And let's say for if it is from anything greater than 2000 to something like 5000, you can consider using 50 paise per block, and you can do the math and you can arrive to the settings. And if it is more than 5000 to 30,000, somewhere, something like a Nifty or Bank Nifty, I'll be always prefer using 1 if the volatility is very less. Volatility is less, and possibly I'll be using 2 if volatility is more. Something like, if let's say the day range itself 200 points in a day or 300 points in a day, then I'll be moving to 2 blocks. At each and every price level, I'll be putting a 2 block size instead of 1. So my equivalent software settings will be, I'll be putting 20 over here. That 20 will be multiplied by 0.05 and becomes 1 point TPO or 1 point block. When it comes to 2, I'll be using 40. That will be multiplied by 0.05. And if the volatility is more, I prefer using a software settings of 40 over here. So order flow, what time frame we need to monitor? Like if you're a beginner, it is always good to monitor in a 3-minute and a 5-minute block. For an expert, if you want to use something like an R delta kind of setups, it's good to go and use on a range bar charts. So range bar charts, it's for the experts. And if you're a beginner, always I would say like try to start with 3-minute or a 5-minute charts to observe the order flow. If you're a scalper, you can use both range bar charts and then on a minute time frame charts. if you're an expert, it's always good to use with 8 blocks or 10 blocks order flows. Whenever I'm talking about 8 blocks or 10 blocks order flow, I'm talking about range bar charts. So if you're a range bar chart user, you need minimum of 8 to 10 blocks to justify what is happening in the markets. So if you want to trade with 8 to 10 blocks movements, means, I mean, it depends upon what kind of player you are, how many points you want in scalping. So if you are looking for 10, 20 points scalping in Nifty, then you have to use a minimum 8 to 10 blocks. So it depends upon what kind of trader you are. You have to control your range bar charts. So if if you are using if you're looking for 18 points, 20 points kind of movements, then you have to go with 8 to 10 blocks of range bar charts. That is why precisely R Delta uses it. This order flow works on individual stocks also. Yes, it can be used for individual stocks. You can use the same thing for. So what I'm going to show you here is an USD/INR charts. Here is the order flow charts for USD/INR. So you'll be seeing a table of something like this, where you'll be able to see the flow which is coming in NSE, USD/INR futures. You'll be able to see that same blocks over here. It's a 5-minute charts, and precisely it tells you where the momentum is coming in, where the selling quantity is coming in, and where the big quantity is coming in. Everything it records you, and it shows you the complete picture about it. I mean, basically, it's like looking into the candlesticks. It tells you more information about that particular candlesticks. And in fact, you can also, there are certain levels which will tell you these are going to be a short-term support level or resistance level for scalping. That again tells you a couple of trading strategies related to that. Okay, you can, to set the block size, right click over the charts, go to indicators. Probably in this case, the USD/INR, when I'm talking about USD/INR, here is what the brick size I used as 2. That will be multiplied by ticks. The tick size in USD/INR is different. It's 0.0025, right? So that's a minimum tick size possible in USD/INR. That is multiplied by 2. That means my each and every block size is 0.005. That's the minimum tick size possible, right? So it records each and every block is 0.005. That's a tick size which I'm using over here. Whereas if you look into my Nifty charts, there is my Nifty order flow. Right, so if I right click and go to indicators, you'll be finding 20 over there. So the brick size, it's called as a tick size, brick size, or a TPO size, or an as I said, it can be of any names. I'll be using 20 or 25. I prefer using 20 over there generally. 20 or 25 is the value. By default, if you apply 25, will be coming in, but I'll be using 20 mostly. So whenever you're applying, it takes a little bit time. So it is calculating, and probably a couple of seconds, you should be able to see the charts once you apply it. Would you recommend order flow for gold and crude also? See, order flow it's regardless of any trading instrument, the concept is going to remain the same thing. There is nothing like it works only in 3-minute time frame. It works in 5-minute time frame. The same concept you can apply on a hourly time frame also, right? But most of the data vendors for Indian markets, they limit only for 2 or 3 days of data. So you need a continuous flow of data to manage if you want to plot for a hourly chart or if you want to plot for a 30-minute candle. In such a case, it's always good to go with. It's always a good place to go and get for. It's always good to go and get for an 5-minute or 3-minute are a good time frame to operate, or even you can operate at a 1-minute time frame also. But I prefer going with 5-minute time frame mostly. You can use for gold and crude. Internationally, many people are using order flow for gold, crude, to trade silver, copper, and even natural gas. The people use for natural gas as well. Right? And in fact, they use for bonds. and they use for ES Mini to trade international to trade for international currencies. They use order flow. So the bid ask difference, generally I used to keep on 10x. 10x will work anywhere between, the default settings will be 3, and you can use anywhere between 5 to 10 to differentiate the bigger momentum players. I prefer using 10 for Nifty, and for Bank Nifty I use 10. See, I don't trade commodities, so I'm not the right guy to explain anything on commodities. I'm more of a Nifty, Bank Nifty, a stocks trader. So if you ask about order flow about stocks, I could explain. Okay, any other questions? Okay, then if there are no questions, then we are done for the day. Then we'll again catch up with more interesting order flow strategies next time. And thanks for your time, as usual. Thanks for your long time commitment. And thanks for sitting with me and patiently listening to me. Right? Thank you once again.